Lucas McMillan back here with a short video. I wanted to put together a video about fixed income. This is an area that is often ignored in financial models, and I think there's some interesting aspects to it that may not be considered very often, especially in the context of putting together a financial plan. So let's start just by looking at, we've got a bit of a test account here. We're assuming it's a bond account. And I'm going to run two different types of bond portfolios. We have one that has 50% of the return coming from interest and 50% coming from capital gains. And you may think, how is that possible? Well, a lot of bond funds specifically are buying and selling bonds, and so they're actually getting a capital gain or sometimes a capital loss. When we think of fixed income, we tend to think of those bond types investments as only producing interest. So let's have a look at the difference. Again, Camber, we're using FPSC reference values to model fixed income in our financial plans. So nothing here is going to exceed 2.9%. So again, if we look at just the typical way we tend to think of the rate of return for a bond portfolio, we have a 2.9% interest rate of return. But if you actually, dig into, if you're using a bond fund or an ETF or something like that, you can look at on their website the distribution characteristics and actually see if what you own is paying exclusively interest or some mix of interest and capital gains. So we'll put our money in there now. And so for this portfolio, again, we're only using 2.9%, but it's going to be a blend of 1.45% interest and the same with capital gains. So let's have a look and see what kind of a difference this makes in a financial plan. This is just a test client that we've created at Camber that we just run these testing projections on. We're looking here at just investment assets. So real estate has been excluded. And here, every investment that this client is holding is assumed to be 2.9% as a bond portfolio, and it's all interest. And so if we toggle that then to that 50-50 portfolio that we created, you can see here we get quite a nice boost from that better tax treatment from those capital gains. Even though our 2.9% rate of return is unchanged, at the end of the projection we're about $500,000 ahead than our base projection. And so that's a nice win. Kind of looking at it another way, if we just look at, so here we've overlain just the value of the cash account. So the difference between these two areas, here, these are the RSPs, TFSAs, all the registered accounts. This area here is the taxable accounts. They're the cash and margin accounts. And so what we're just plotting out here is how long does this account group last. And so you can see here at their burn rate, they run out of assets in their cash account, in their late 80s, early 90s. But if we overlay that 50-50 mix on the return, you can see you get a few more years out of the portfolio, 5 more years actually out of that portfolio. So it's just another way to look at it that you may not be just looking at it from a dollar value perspective, that actually it'll allow you to spend money for longer depending on the type of return you're getting with your portfolio. And so how do you actually achieve this kind of return? If you're holding individual bonds in your investment account and you just have a handful of them, I would actually make the assumption that you are just going after this sort of steady income and you're holding bonds to maturity. You're not trading those bonds. To be able to get access to a return like this, you'd really want to be looking at a bond fund, or maybe even better yet, a fund of funds. If you look at individual bond funds, they can be quite specific to their mandate, looking at different types of credit quality. So one fund might be investing in AAA and AA and not very low quality credit, where another bond fund could be investing in lower credit, looking for higher interest payments. Corporate versus government bonds. Again, not all of these bond funds are built the same. and the geographic spread of where these bonds are, would also differ by funds. This is one situation where using a fund of funds structure can actually add a lot of sophistication to your bond holdings. And I would say if you're the type of investor where you have the risk tolerance for a 100% equity portfolio, I wouldn't just immediately discount that you couldn't have some fixed income in that mix, because you can hold the right type of fixed income to go after some sort of a better tax treatment return. And it would give you some nice diversification to just holding a 100% equity portfolio. So maybe you look at putting 10 or 20% of your money into a bond strategy where you're pursuing more than just income, you're pursuing income and capital gains. So I hope this was helpful. Thank you.